All eyes will be on the UK economy in the coming week to see if there really is going to be a bounce in activity in the wake of the election and the passing of the Brexit bill back in December. There are already some tentative signs of improvement in soft indicators, such as the Confederation of British Industry survey of 300 manufacturers. In the 3 months of January, that showed the fastest rise in business optimism since spring 2014, and it also featured hints that companies were looking to invest more. Now, the next set of data comes in the Purchasing Managers Indices, or PMIs, where, if you remember, a reading above 50 is consistent with expansion or growth, one below 50 can signify a slowdown or even a drop in activity. Now, in the UK, the manufacturing, construction and service industry surveys come out on Monday the 3rd, Tuesday the 4th and Wednesday the 5th of February respectively. We can see the trend here since the EU membership referendum vote in June 2016, and in fairness the chart is no work of beauty. Just to also remind you, last month's readings were as follows. Manufacturing fell to 47.5, construction fell to 44.4, but services improved marginally to exactly 50. Now, economists, politicians, investors and the Bank of England will all doubtless be hoping to see some signs of improvement, especially those investors who are buying into the bounce theory and feel there's value in UK domestic stocks like banks, house builders and construction players, and who knows, maybe even retailers and real estate stocks as a result. Now, on the corporate front, a wide selection of FTSE 100, FTSE 250 and small cap firms are scheduled to publish results or a trading update or host their annual meeting for shareholders in the coming week. They include BP, Glencore and Ocado on Tuesday the 4th of February, Vodafone, Barratt Developments, Imperial Brands and Rio Tinto on the 5th, EasyJet, Compass and one-time FTSE 100 member Royal Mail on the 6th, and finally house builder Bellway on Friday the 7th of February. But for all of those, the name perhaps most capable of causing a fuss in the week ahead is pharmaceutical giant GlaxoSmithKline, due to release full year results on Wednesday the 5th of February. Remember, within the FTSE 100, the firm's the 5th biggest by market cap, 7th biggest by profit, 5th biggest dividend payer for 2020, according to consensus analysts' forecasts. Since Emma Walmsley took over as chief exec in April 2017, she substantially changed the company's strategy, moving away from the three-legged structure built by predecessor Andrew Whitty, based on pharmaceuticals, vaccines and consumer healthcare. Emma Walmsley's changed that to increase the focus on pharmaceuticals, and she's done it through 4 really pretty big transactions. In June 2018, GlaxoSmithKline bought in the stake it didn't own in its consumer healthcare business from Switzerland's Novartis, so it had 100% of it. December 2018, the firm then sold Horlicks and other consumer nutrition brands via a merger with Hindustan Unilever. Also in December 2018, GlaxoSmithKline bought US biotech firm Tersaro for just over $5 billion, and in the very same month, the company announced a merger of its consumer healthcare business with that of Pfizer, with a plan to then demerge its stake in the bigger venture in 2022. Still with me? Good. Because so far the market's liking what it sees, judging by the share price performance over the past 12 months. One reason why the shares have done so well, another reason why, is the company's also raised its earnings guidance twice in 2019. So that when it comes to these full year figures, analysts will measure GlaxoSmithKline's performance against the raised bar. And analysts and investors will home in on 3 sets of numbers in particular. The first is sales or revenues, as this will indicate how GlaxoSmithKline's new drugs are helping to compensate for the loss of patent protection on older ones. In the third quarter, sales rose 6% on a constant structure basis and 11% including structure changes, excluding currency movements. Using the latter format, pharmaceutical sales were up 3%, vaccines up 15% and consumer healthcare up 25%, thanks to that Pfizer deal. This chart shows the constant currency progress since Q1 2017, just before Emma Walmsley took over. Second set of figures watched will be earnings per share. At the third quarter stage in October, Emma Walmsley forecast that adjusted earnings per share, or EPS, would come in broadly flat year on year at 119.4p. Now that compared to an initial estimate of down 5 to 9% and then June's upgrade to down 3 to 5%. Stated earnings per share, by the way, including all the nasties, was 73.7 pence a share. And then finally, analysts and investors will look at the dividend. The company's already said it will pay an unchanged figure of 80 pence a share for this full year 2019. After that, GlaxoSmithKline has made no commitments, with investment in research and development a top priority and shareholder returns also high up its list of capital allocation options. GlaxoSmithKline hasn't increased its dividend since 2014, and earnings cover for the dividend is lower than ideal at around 1.5 times, according to analysts' forecasts, even using the adjusted earnings per share numbers. Really, a cover of 2.0 times would give greater comfort. On a more qualitative basis, analysts will look towards the pharmaceuticals business and its pipeline. GlaxoSmithKline's best-selling drug is bronchitis treatment Advair, but that's now off patent and faces generic price competition, so sales are expected to have fallen sharply in 2019. To compensate for that, the company is looking to show that its pipeline of new drugs is filling. It's got 41 medicines and 17 vaccines in development from phase 1 to phase 3 trials, and analysts will be looking for progress reports here and on any new product filings. In addition, investors will look to updates on 3 drugs in particular. They're shingles vaccine Shingrix, HIV treatment Juluca, both already on sale, and cancer drug Zejula. Once analysts have digested that lot, they'll look to Emma Walmsley for any guidance on 2020. The current consensus forecasts are looking for a 3% drop in earnings per share and a flat dividend at 80p a share. Thank you for watching, and I look forward to seeing you next time.